Hi, this is Rowland for Money Markets TV. As the sovereign debt crisis in Europe spirals out of control, debt-ridden nations are facing sharply higher borrowing costs. The yield on Spain's 10-year government bond is now closing in on 7%, the same level at which Greece and Italy both had to be bailed out last year. At the same time, stronger governments like Germany and the US can finance their spending cheaper than ever. The yield on 10-year U.S. Treasury notes dipped below 1.5% last week, and German bond yields are even lower. So, how do these trends affect ETF investors? Well, there are a lot of exchange-traded funds that are based on government securities. And if you pick the right ones, small changes in interest rates can mean big profits for you. For example, take ETFs based on zero-coupon Treasury securities. These bonds strip out the income component, so they're almost completely dependent on interest rate changes. To show you what that can mean for ETFs, let's take the past 10 weeks in the bond markets. During that time, interest rates on U.S. Treasury notes with maturities over 25 years fell from 3.48% to 2.56%. That's a pretty big move. But now look what happened to the PIMCO 25-plus year zero-coupon U.S. Treasury Index Fund, symbol ZROZ. It soared by more than 30%, and that's without any leverage. If you'd invested in this ETF, you would have gotten about 10 years worth of yield income in just 10 weeks. Of course, opportunities like this are always easy to spot in hindsight, but buying and selling at just the right time isn't so simple. And ETFs that rise so fast can also fall just as hard. Let's go back to late 2010 and early 2011. Over roughly 5 months, Zero's investors saw their principal value drop by nearly a third as long-term interest rates rose. If the interest rate trend turns around, we could see big moves in another category, inverse bond ETFs and ETNs, which are designed to move up when bond prices fall. These types of instruments are designed for short-term trading, and timing them correctly presents another challenge. Interest rates are prone to sharp, unexpected changes and are highly sensitive to economic or political news. So even if you do everything else right, simple bad luck could lead to big losses. If you're comfortable with the risk, several ETF sponsors offer long maturity inverse bond instruments, including ProShares, Direction, and PowerShares. TBT and SBND offer double and triple leverage respectively, so they promise an especially wild ride. Interest rate forecasting is tough, even in normal times. Right now, it's even tougher. But if you're up to the challenge, the profits can be huge. I'm Ron Rowland for Money Markets TV. Thanks for watching.